Stock options. You've probably heard people throw that word around. I made money with calls, or I'm hedging with puts. And you might be thinking, what in the world are they talking about? Don't worry. In the next few minutes, I'm going to break down stock options in the simplest way possible. Literally for dummies. By the end, you'll understand what options are, why people trade them, and the difference between calls and puts. No jargon, no confusion, just straight talk. Okay, imagine this. You want to buy a house, but you're not ready yet. You tell the seller, hey, here's $1,000. Hold this house for me for the next 3 months at today's price. If I decide to buy, I'll pay the agreed price. If I don't, you keep my $1,000. That's basically how an option works in the stock market. An option is a contract. It gives you the right, but not the obligation, to buy or sell a stock at a certain price within a certain time. And just like the house example, you pay a small amount up front called the premium to lock in that deal. Now there are two main types of options. Call options. A call gives you the right to buy a stock at a certain price. You'd buy a call if you think the stock is going up. Example, Apple stock is at $100. You buy a call that lets you buy it at $100 in the future. If Apple jumps to $120, you're winning because you can buy at $100 and sell at $120. Put options. A put gives you the right to sell a stock at a certain price. You'd buy a put if you think the stock is going down. Example, same Apple stock at $100. You buy a put that lets you sell at $100. If the stock falls to $80, you're still able to sell at $100. That's a profit. So why do people even bother with options? Leverage. Options let you control 100 shares of stock with way less money. Instead of buying 100 Apple shares at $100 each, $10,000, you might buy one option for $200. That's powerful, but also risky. Hedging. Big investors use options like insurance. If they're worried the market will crash, they buy puts to protect their portfolio. Income. Some advanced traders actually sell options to collect the premium, like an insurance company. Bottom line, options aren't just about gambling. They're tools for managing risk and boosting returns. Here's the part most beginners miss. Options expire. Unlike owning stock, you don't get to hold them forever. If the stock doesn't move in your direction before the expiration date, your option can expire worthless, and you lose the money you paid. That's why you'll hear traders talk about things like strike price, expiration date, and theta, time decay. We'll dive into those in future videos, but the key idea is this. Options are ticking clocks. You've got to be right on price and on timing. So let's recap for dummies. Options are contracts that give you the right to buy or sell a stock at a set price. Calls bet the stock goes up. Puts bet the stock goes down. They can make you money with less upfront cash, but they expire and can go to zero. Now, I want to hear from you. Are you more interested in using options to grow your account quickly or as insurance to protect your portfolio? Comment below and let's talk about it. And if this helped clear things up, make sure you smash that like button, subscribe for more easy to digest trading guides, and grab our free options trading checklist at ITeachStocks.com. See you in the next one.